You ever feel like you huppered on every single trend out there, but still ended up getting played? This full 1 hour deep dive took me months to put together. I've broken down the ultimate truth about getting rich using the core mindsets of tons of self-made millionaires. Let me say this up front, most people never make big money, and it's not because they don't work hard enough. They get their core beliefs wrong right from the very start. Wait till you get to chapter 3 at the end, you'll spot a hidden self-sabotaging habit that 99% of people fall for. Cut this habit out, and your wealth will start snowballing for real. Stick around till the end. This 1 hour could save you from making costly money mistakes for the next decade. All right, let's cut straight to the point. Why do I say investing is all about faith? A lot of people see investing as just buying and selling, a numbers game, or even gambling. But here's the real deal. When you invest, you trade your real assets today for uncertain returns down the line. Along this long journey, you can't see or touch what the future holds. The only thing that keeps you holding onto your assets, riding out market swings, and weathering both bull and bear markets is your unwavering belief in the future, your investments, and the strategy behind them. That's what I call faith. You can only earn money within the limits of what you truly understand, and your understanding stops right where your faith ends. Your beliefs shape the profits you make. Even if a stock is set to surge tenfold tomorrow, you won't hold on to it if you don't believe in it. Take compound interest over the long run, for example. If you truly believe in it, you'll trust companies with steady growth and consistent dividends. You'll get excited when the market dips, because that's your chance to stack up more shares. But if you lack that belief, every price swing will fill you with anxiety and doubt, and you'll end up selling at a loss. The truth is, most people never build genuine faith when it comes to investing. Their so-called beliefs are flimsy, swayed by market noise and their own emotions. This leads them to make one of the biggest mistakes right out the gate, and that's what we're diving into next, blindly chasing rising prices. Chapter 1, Chasing Rallies, Fake Faith Ruled by Emotions. What does chasing rallies really mean? On the surface, you buy because you believe in its future. But put your phone down, close your eyes, and be honest with yourself. Do you truly understand its potential with solid logic, or are you just reaching for your wallet because the price keeps climbing and dopamine is taking over? Most retail investors don't build their beliefs on the fundamental value of assets. Instead, they fixate entirely on the steepness of the price trend. When the price shoots up day after day, they treat the asset like a miracle, a groundbreaking game changer. But the second it drops, they call it a scam. This kind of fake faith, driven purely by market sentiment, has trapped countless people throughout history. We don't even need to look far back. Let's go through 3 recent, hard-hitting real-life stories. Ask yourself, were you also on that train heading straight for disaster? First up, Cathie Wood, hailed as the queen of the bull market around 2021. Her ARKK Innovation Fund held heavy positions in tech stocks like Tesla and Zoom, delivering incredible returns back then. YouTubers and mainstream media across the internet glorified her, claiming traditional value investing was dead and disruptive innovation was the only future. Hordes of investors piled in when ARKK hit its peak above $150. Many even traded with leverage. They were utterly convinced that technology would change everything. So what happened next? ARKK crashed by nearly 80%. Countless people lost years of savings at the top, becoming nothing more than casualties of the so-called tech revolution. You thought you believed in tech, but in truth, you only believed in that sky-high price chart. The second story is even more ridiculous. Back in 2021, Elon Musk just posted a few random tweets, and Dogecoin, originally created as a joke, surged over 100 times in value in just a few months. After that, Shiba Inu coin and all kinds of animal-themed crypto coins went absolutely wild. Office workers, delivery drivers, even elderly folks were all talking. Did you buy Dogecoin today? Faced with intense peer pressure, seeing others make in a single day what you earn in a whole year, you finally caved in. At the peak price of 7 cents, you dumped every penny you'd saved for a house into it, going all in. You told yourself you were part of this great decentralized financial revolution. But the truth hit hard. Once Musk said on a TV show, "It's a hustle," the bubble puppered instantly. All your hard-earned money just became the cleanup cost after everyone else's wild party. If you think you steered clear of these trendy assets, let's talk about the traditional stock market instead. Back in 2015, China's A-share market saw a massive bull run. Hordes of investors piled into margin trading and used heavy leverage, buying into the hype of a national bull market and reform-driven rally. Brokerage houses were packed with long lines every single day. Even the cleaning ladies were handing out stock tips. Everyone online kept saying, "When the wind blows, even pigs can fly," and claiming the index would hit 10,000 points. People were convinced this time was different, that they were riding the national trend. When the index peaked at 5178 points, how many people ended up buying at the very top? What followed was a nightmare. Thousands of stocks plunged to their daily limit, and liquidity dried up completely. Those who traded on leverage didn't just lose all their capital, many even lost their homes. Look at ARKK, Debunked, and the 2015 A-share rally. Different assets, different times, yet the core of chasing rallies is exactly the same. You pay a sky-high price for a hollow belief you don't truly understand. So if chasing rallies is a losing game, what if I stay away from it, wait for prices to drop, then buy the dip to grab a bargain? That should work, right? Smart retail traders, here's the second sneaky yet deadly trap the market sets for you. Chapter 2, Chasing Bargains. Chapter 2, Chasing Bargains, the deadly value trap. Lots of investors think they've got it all figured out. After watching others lose everything from chasing rallies, they tell themselves smugly, "I'm not that foolish, I'd never buy at the peak. I'll just wait until prices crash, then buy the dip. How could I lose money picking up cheap assets?" Folks, this is where the market hits hardest. Those who chase rallies fall to an obvious blade, while bargain hunters get swallowed up by soft, deadly quicksand. In investing, a low price never equals a good deal. Many assets drop by 90%, not just because the market cuts their valuation, but because their fundamentals have completely collapsed. A bad stock that's already halved in value can keep falling by half again. Even if a stock has tanked 90%, it can still drop another 90% before it hits zero. You might think you're doing value investing just like Warren Buffett, but in reality, you're just digging through trash for expired goods. Don't believe me? Let's go over 3 classic buy-the-dip disasters that wiped out countless so-called smart investors. First up, what was once the world's top real estate developer. When major developers like Evergrande and Country Garden hit crisis points, their share prices plummeted 80% to 90% from their highs. They eventually turned into penny stocks trading at just a few cents. Right away, crowds of investors rushed in, betting on big risks for big rewards. Their logic seemed airtight. These are huge companies, the government won't let them fail. A restructuring is bound to happen, and even a small rebound will bring multiple returns. This is pure bargain chasing. They ignored the massive debt hole worth trillions and the total shift in market supply and demand. What happened next? Instead of bouncing back, these stocks faced prolonged trading halts, liquidation, and eventual delisting. Those so-called cheap shares, in retail investors' hands, ended up worthless pieces of paper. The second case marks a turning point in tech history. Back in 2000, the Nasdaq.com bubble burst. Cisco, the world's leading network equipment giant, saw its share price tumble sharply after hitting its peak. Many value investors got excited. They thought, Cisco is the backbone of the internet. Even if the whole internet sector is a bubble, people still need its routers, right? It's already down 50%, this is a total steal, so they rushed in to buy the dip. But the price kept falling another 50%, and then another 50%. In the end, Cisco lost nearly 90% of its peak value. Those who bought on the way down chasing cheap shares still haven't broken even 20 years later. They fell victim to the false belief that they were holding rock-solid assets. The third example covers century-old industry titans once deemed too big to fail. When smartphones and digital tech took over, Nokia and Kodak's stock prices drifted lower year after year. Retail investors crunched the numbers and thought they'd found a smart bargain. Kodak owns tons of patents, Nokia has massive market share and steady cash flow. Its PE ratio's down to single digits, it's unbelievably cheap. They called this contrarian investing. But they overlooked one critical truth. Once an entire industry gets phased out by new eras, its once valuable assets turn into liabilities. R&D campuses become dead weight, and valuable patents end up worthless scraps of paper. You chase tiny dividend payouts and low share prices, while the stock eats away at your principal little by little. These firms didn't crash overnight. Over more than a decade, they sliced up bargain hunters, savings bit by bit just like cutting sausage. See the pattern? Folks chasing rallies lose to blind frenzy, while bargain hunters get ruined by overconfidence. At this point, countless investors throw in the towel. They admit they're bad at reading price charts and lack the skill to parse financial statements or spot industry shifts. That pushes them toward the third, easiest yet deadliest trap. If I can't pick winning stocks on my own, I'll stop picking entirely. I'll follow whatever's trending and jump into hyped-up sectors. All those viral market fads and insider tips blowing up online can't possibly be scams, right? Well, congratulations. You've walked straight into the final butcher's blade, designed to wipe out retail cash. Chapter 3: Blindly Following Market Hypes. Second up is the red-hot new energy craze from a couple years back. Remember hearing the slogan, "Gas-powered cars are doomed. New energy will upend everything," on repeat until your ears hurt. News outlets flooded people with endless hype pieces, and brokerage analysts swore lithium battery prices would keep climbing forever. Caught up in this supposed universal consensus, retail investors tossed aside valuation and earnings checks, dumping money blindly into any stock tagged new energy or lithium mining. Then 2024 rolled around. The industry wound up with massive overcapacity, triggering brutal price wars. Lithium prices collapsed by 80%, and share prices of leading new energy firms got cut in half twice over. Folks who blindly chased the green future hype ended up watching their portfolios get wiped clean by that very green revolution. Third on the list is today's undisputed market king, AI. Ever since ChatGPT blew up worldwide, AI's been marketed as a cure-all for every business trouble out there. Nvidia's stock surge made sense to investors, but here's the absurd part. Any failing company can triple its share price in just a few days simply by slipping a line into its earnings report about rolling out large AI models, or even renaming itself with AI Holdings in the title. Terrified of missing out on the so-called Fourth Industrial Revolution, hordes of retail investors pile into these loosely related AI plays without fact-checking whether the firm actually owns real tech. Once quarterly results drop, and it turns out these businesses only have AI written on slide decks with zero functional algorithms, their stocks crash off a cliff by as much as 90%. Hype can absolutely change the world, but before it does that, it'll drain your bank account first. After going through these 3 chapters and 9 brutal real-world examples, does a chill run down your spine? You might start questioning yourself. I lose money chasing rallies, lose money hunting cheap value traps, and still get crushed following trending themes. How am I ever supposed to survive this brutal market? Am I doomed to keep getting fleeced forever? Take a breath. From 12 years running businesses and investing, I've learned most people mess up right here because they misunderstand what losing money actually means. Let me be straight with you. Early on in your investing journey, taking losses isn't something to fear. It's your single most valuable asset to pull ahead of average investors. Why do countless multimillionaires insist you should lose money early in your investing career? Now let's jump into Chapter 2. I'm going to break down a $1 million investing framework step by step, showing you how to turn your early trading losses into steady compounding passive income for the next decade. If you're a regular 9-to-5 worker with little startup capital and only living off your paycheck, the second section will completely rewrite how you think about building wealth from your job. So here's Chapter 2, Lose Money Early. Right off the bat, a lot of you might push back instinctively. Wait a minute, I'm here to learn how to make money. Why are you telling me to lose cash sooner rather than later? Guys, this is the critical mental divide separating everyday folks from elite investors. Average people see losses as the end of their wealth journey, but wealthy pros view early losses as the cheapest, most worthwhile tuition to buy market wisdom. Think about it, if you're bound to pay $100,000 as your market tuition, would you rather fork it over at age 25 when your total savings are only $100K? Or wait till you hit 50 after saving up millions for retirement, only to wipe everything out on one reckless trend chase? The best time to plant a tree was 10 years ago. The second best time is right now. Same logic applies to investing losses. The optimal window to take hits is when you're young, your principal is small, and bouncing back costs almost nothing. Small early losses are the market's low-cost way to weed out your fatal flaws: overconfidence, greed, and blind herd mentality. They yank you out of unrealistic get-rich-quick fantasies and force you to face the cold, hard rules of the marketplace. As long as you don't get wiped out entirely, every dollar you lose early becomes permanent financial immunity that shields you from scams and catastrophic market crashes down the line. That said, there's a catch to turning early losses into future riches. You have to walk away from every loss with matching actionable investing know-how. If you just lose money blindly, then keep gambling away your cash, you're nothing more than an unlucky loser. So how exactly do you convert early losses into lifelong compound wealth? That's our first segment coming up. Stick to long-term investing and master a proven strategy that holds up through both bull and bear markets. Section 1. Go long-term and master a solid investing system. Once you stop fearing losses and instead aim to grow smarter from every setback, you need to arm yourself with a powerful edge, a proven long-term investing framework. Most folks misunderstand long-term investing, writing it off as buy and forget, hold for a decade without checking. That's just laziness, not a legitimate strategy. Genuine long-term investing is a refined mathematical system built around three core pillars: mean reversion, margin of safety, and asset allocation. It's about organizing your capital like a disciplined army. Don't fixate on short-term wins or losses from single trades. Instead, leverage compound growth over time to capture the inherent upside of humanity's ever-expanding economic output. Wise investors never gamble everything on one stock shooting through the roof. They stick to a crash-proof system that works across bull and bear cycles, staying calm amid all the market noise. To show you how powerful this approach really is, let's break down three legendary long-term investors who built their fortunes entirely on structured systems. First up, the gold standard of long-term investing, Warren Buffett and Coca-Cola. Back in 1988, right after Black Monday's brutal 1987 U.S. stock crash left investors panicking nationwide, Buffett started loading up on Coca-Cola shares. Lots of critics mocked him for sinking money into an outdated business that just sold sugary soda. But Buffett's core investing rule was simple: hunt for top-tier businesses with wide economic moats, inflation resistance, and consistent everlasting cash flow. Monthly price swings meant nothing to him. He held that position for more than 30 years, weathering countless financial crises and the dot-com bubble along the way amid endless market volatility. To this day, the investment has multiplied dozens of times over, and annual dividend payouts alone from Coca-Cola now exceed his original purchase cost. That's rule number one of long-term investing: build compound returns alongside outstanding businesses. The second case features an investment playbook revered by institutional investors everywhere: David Swensen and the Yale model. Average retail investors spend all their time hunting for the next hot stock, but elite long-run masters focus entirely on asset allocation. While managing Yale's endowment, Swensen pulled off decades of consistent outperformance across multiple market cycles. His core long-term rule boils down to not putting all your eggs in one basket. He dynamically rebalanced across stocks, bonds, real estate, commodities, and private equity. Whenever equities skyrocket and other asset classes sink, he ruthlessly trims stock holdings to snap up underpriced alternatives. When stocks crash hard, he uses cash flow from other assets to add more equity exposure. This framework strips human emotion completely out of the equation, letting the endowment systematically buy low and sell high over the past 30 years. Long-term investing isn't stubbornly holding stocks based on blind faith. It's letting structured rules self-correct your portfolio automatically. Third up is an investing blueprint that has saved hundreds of millions of everyday investors worldwide, the brainchild of John Bogle, the father of index funds. He rolled out a game-changing idea that shook Wall Street to its core. Don't waste time hunting for a needle in a haystack, just buy the whole haystack. Regular folks lack the time and expertise to pick individual winning stocks, so what's the fix? Bogle created the S&P 500 Index ETF. His strategy is refreshingly straightforward. Own stakes in America's 500 largest publicly traded businesses. As long as civilization keeps advancing and technology evolves, these top 500 firms naturally rotate. Weak companies get booted out, while thriving new leaders get added to the index automatically. You never need to stress over which single firm goes bankrupt. The index cleans up the losers and brings in top performers on its own. Historical data bears it out. Over the last century, average investors who stick to regular dollar cost averaging into index funds and reinvest all dividends outperform over 90% of professional fund managers actively chasing gains. This is the ultimate long-term blueprint for regular people. Earn broad market beta returns riding on economic and societal progress. I know a bunch of you are already backing off right now, thinking, everything you're saying checks out, but those legendary investors have piles of cash to wait out the market over decades. I'm just an ordinary employee scraping by, barely covering monthly bills with spare change. How am I supposed to afford ongoing regular investing? Asset allocation feels totally out of my league. Great question. This is exactly the core reason why 99% of retail investors fail to build big wealth even after learning long-term investing basics. They're trying to raise a giant whale inside a tiny dried-up pond. Long-term investing's full power hinges on one harsh prerequisite. You need a steady stream of outside income feeding your portfolio non-stop. Without consistent extra cash flowing in, one unexpected life emergency can force you to sell your holdings at a loss and kill your long-term plan cold. So how can regular people build their own steady cash cow engine fast? How do you find asymmetric opportunities that can shift your financial status without needing large startup capital? Stay focused, because we're jumping into the most actionable segment of the whole video, section 2. Master your core career and experiment widely. A lot of viewers get skeptical the second they hear double down on your day job. If I could get rich off my regular work, I wouldn't be here watching your investing videos. I came to the stock market to escape my 9-to-5 grind. Guys, that's your biggest mental blind spot. Investing magnifies the gains from your core skills. It's not a hiding spot to run away from your own shortcomings. The secret to building serious investment wealth isn't hitting a 100-bagger miracle stock. It's securing steady outside cash you can funnel into the market consistently. Your full-time career is your financial foundation, the backbone that lets you keep dollar cost averaging through brutal bear markets and load up heavily during market crashes. Still, grinding away mindlessly at your job like a workhorse isn't enough either. While hunting your main profession, test new side ventures with minimal upfront cost. This is exactly asymmetric betting. What's an asymmetric bet? Your downside is capped. You only lose spare free time or a few $100 if it fails. But the upside is unlimited. One big win can blast through your income ceiling and catapult you into an entirely new wealth bracket. Nail just one side project outside your regular job, and your wealth snowball can blow up faster than you can imagine. To drive this home, Let's go over 3 iconic people who completely transformed their lives by mastering their main career while testing new paths. First up, Nassim Taleb, author of The Black Swan, who perfected this exact framework. Early in his career, he worked as an elite derivatives trader on Wall Street. Mastering that field guaranteed him a hefty base salary and top-tier industry expertise, his solid safety base. Instead of burning all his hours working overtime non-stop, he spent spare time diving into philosophy and statistics, trying his hand at book writing and university lectures. His day job covered all living expenses comfortably, while his breakout books The Black Swan and Antifragile became worldwide bestsellers. They earned him massive royalty checks and cemented his status as a globally renowned thinker. This is the famous barbell strategy. One end is stable full-time income for defense, the other is high-upside experimental ventures for explosive growth. Our second success story hits close to home. Dr. Wang Jian started out as a professor and department head of psychology at Zhejiang University. To most people, that was a rock-solid, lifelong stable career and the peak of his career path. Still, he never stopped exploring uncharted territory. While refining his expertise in psychology and human-computer interaction, he spotted the massive upcoming trend in big data and cloud computing. He stepped outside his comfort zone, branched into computer science research, and joined Microsoft Research Asia. Later on, he moved to Alibaba and built Alibaba Cloud from scratch amid widespread skepticism, cementing its dominant position within China's entire cloud industry. Had he stuck rigidly to being a psychology professor, he would have turned into an accomplished academic, yet never the industry titan reshaping China's internet landscape. When you build your core competence and reputation from your main career before branching out into new fields, you unlock explosive, fusion-level growth. The third example is a real-world asymmetric bet anyone can replicate. Across the globe, these days, tons of software engineers, designers and finance analysts hold regular corporate desk jobs stuck as small cogs in big tech firms. Instead of gambling on stocks chasing overnight riches, they spend every weekend turning their professional know-how into short 5-minute YouTube clips, coding tutorials, spreadsheet hacks, or career coaching tips. What's the downside if it flops? They only lose a couple of weekends of leisure time at practically zero cost. But if one video catches the platform algorithm and racks up millions of views, they earn solid AdSense revenue, launch paid channel memberships, and land consulting gigs. Within 2 or 3 years, passive income from this side hustle outpaces their full-time salary entirely, letting them take full control over their own schedule. This is low-cost, asymmetric entrepreneurship, tailor-made for today's workforce. See how it all ties together? That's the full closed-loop logic behind lose money early. You forge a rock-solid long-term DCA and asset allocation system through early investing losses. Then you feed an endless stream of fresh capital into that system via asymmetric opportunities built on hunting your core job and testing side projects. Once you've got these 2 tools locked in, you've checked every mental box needed to build serious wealth. But why do 90% of people who learn all these principles and even put the strategies into practice get stuck at the final hurdle, never crossing the divide into wealth? Let me lay it straight. There are no hidden tricks to getting rich. The real secret lies in self-sabotaging character flaws most folks never spot their entire lives. Now we jump into Chapter 3, the most valuable, hard-hitting segment of this full 1-hour video, the part that might even make you uncomfortable. I'll break down 3 toxic flaws that trap most people in lifelong poverty. The third one especially, clinging to the past and refusing to let go. It locks 90% of regular folks inside invisible wealth shackles. If you skip this chapter, every investing and career strategy you've learned so far is nothing more than sandcastles. One sudden market gust can wipe you out completely. Let's dive straight into Chapter 3. Getting rich has no hidden secrets. The market is flooded with self-proclaimed gurus and money-making communities hawking exclusive, get-rich shortcuts, and insider hacks hidden from ordinary people. People chase these secrets obsessively, convinced a magic key will instantly lift them into a higher social class. After 12 years running businesses, investing, and connecting with countless self-made millionaires, I can tell you for a fact, there are no closely guarded secrets to building wealth. Every proven path is plainly laid out in history books, public financial formulas, and counterintuitive behavioral logic. If the path to prosperity is out in plain sight for everyone, why so few ever walk it? Because building wealth isn't just a fancy mathematical formula, it demands deep self-examination and personal reinvention. Strategies are public knowledge, yet most people carry massive flaws in their core mental operating system. Their minds are weighed down by closed-mindedness, laziness, and stubborn fixation on sunk costs. These mental gaps act like black holes, swallowing every investing rule they learn and every hard-earned dollar they make. Unless you're willing to overhaul your own flaws and confront the self-destructive habits buried deep inside you, no amount of knowledge saves you from being someone who knows all the right lessons, yet stays stuck as a losing retail investor. To patch these mental gaps and break free from generational financial limits, we start with the first, most misunderstood foundational shift in wealth mindset. First section, what does genuine wealth actually mean from the wealthy's perspective? Before unpacking common harmful flaws, we need to nail down one critical question: what is true wealth? Average people define wealth as a huge bank balance, Rolls-Royces, hillside mansions, and wardrobes plastered with luxury brand logos. Newsflash, that's being rich, not truly wealthy. At the highest financial tiers, rich and wealthy are two entirely separate categories. Being rich usually means you pull in a large income, but you're forced to grind endlessly, burning your time and health like a workhorse just to keep up your expensive lifestyle. Stop working for even a moment, and those fancy houses and cars turn into crushing liabilities, eating you alive. True wealth boils down to a simple formula. Wealth equals passive income from assets, total personal expenses, and desires. Real wealth isn't measured by flashy possessions. It equals full ownership over your time and the freedom to turn down anything you dislike. Even without punching a clock, your assets pump steady outside cash flow, letting you sleep in on any Monday morning and travel wherever you please. Wealth's ultimate reward is freedom. To highlight this massive mental gap, let's walk through three iconic examples of genuine wealth. First up, Naval Ravikant, legendary Silicon Valley thinker and unicorn startup investor. His globally famous wealth mantra, chase wealth, not money or status. Naval says money is just temporary bank credit that loses purchasing power over inflation, while wealth is an asset machine that earns money for you while you sleep or take vacations. After hitting financial freedom, he skipped the flashy lifestyle of fancy cars and lavish parties. Instead, he spends most days reading, meditating, being with family, and sharing his wisdom for free on Twitter. He embodies true wealth perfectly, using two zero-cost modern levers, code and content, to build automatic income streams that free him from trading physical labor for money and grant lasting inner peace. A second example is a timeless philosophical lesson stretching back over 2,000 years. After conquering most of the known world, Alexander the Great marched with his massive army to visit Diogenes, the philosopher who lived inside a wooden barrel. The mighty ruler offered generously, "I am Alexander the Great. Name whatever you wish, and I shall grant it to you." For your average person, this would mean unimaginable wealth and privilege. But Diogenes narrowed his eyes and replied calmly, "My only request is that you step aside, you're blocking my sunlight." Alexander held dominion over empires, yet he remained enslaved by his own ambition, endless wars and insatiable cravings. Diogenes owned practically nothing, but he fully controlled his time and possessed unshakable inner peace, lacking nothing at all. The highest form of wealth means no outside force can manipulate your desires. Trim unnecessary wants and cover your living costs with passive income, and you've spiritually conquered the material world entirely. The third case is a quantifiable modern financial blueprint anyone can follow. In recent years, a movement called FIRE, financial independence, retire early has blown up among young high achievers worldwide. Its core framework builds on the famous 4% rule pioneered by leading research including work out of MIT. Save up 25 times your annual living expenses, then deploy that capital into the income-generating compounding assets we covered in Chapter 2, such as the S&P 500. Withdraw exactly 4% annually for spending, and your principal will never run out. Plenty of software engineers and managers crunch those numbers and get it. They ditch empty vanity pursuits like luxury goods and fancy cars, live frugally to hit their savings target, then hand in their resignation cold turkey by age 35. From there, they spend their days fishing, painting, writing novels, or volunteering. Their net worth may never land them on the Forbes rich list, but for 5 decades from their mid-30s well into their 80s, they hold 100% ownership of their own lives. That's real, attainable wealth. See the big difference? Being rich is a performative show for other people's eyes. Being wealthy is genuine freedom reserved for yourself. Once you realize we've spent nearly an hour breaking down investing and career building, not to become flashy rich folks schmoozing at fancy social events, but to turn into wealthy people who can say no to unwanted people and opportunities anytime we want, we're ready to dive into the tough part. The formulas are public, the 4% rule is proven, and all the playbooks exist for anyone to use. Why then do most people never build lasting financial freedom even after earning decent money? Deep in their mindset sit 3 self-sabotaging bad habits that feel comfortable, yet keep them trapped forever. Now take a close look at your own daily habits and choices. Let's move into Section 2, the 3 damaging flaws holding back most people. We'll start with the first widespread, crippling flaw, closing yourself off to new information. Section 2, 3 critical mental flaws, the mindset black holes that drain your wealth. Now that we've unpacked the core formula for true wealth and freedom, we have to face a harsh truth. Proven money-making strategies are everywhere online, yet most people remain stuck in a cycle of poverty and constant anxiety. Is it rotten luck, or missing a well-connected mentor? Neither. The real culprit lies in fatal flaws embedded in their core mental operating system, flaws they grow comfortable living with day in and day out. After working with countless retail investors who lost their entire savings and mid-career professionals stuck in dead-end jobs, I've spotted a shared pattern. 3 destructive flaws trap them permanently on lower income tiers. Picture a wealth bucket with massive holes punched in its bottom. No matter how much income you pour in, every dollar drains away instantly. These 3 wealth-killing flaws are willful ignorance, tactical laziness, and obsessive fixation on sunk costs. I'm pulling no punches today to lay bare these mental cancers keeping you poor. Check your own habits to see which pitfalls you've fallen into. Flaw 1, willful ignorance, living inside an information bubble. The saddest trait of people trapped financially is hiding behind arrogant bias inside an echo chamber. They reflexively reject, mock, and dismiss anything outside their existing understanding. Whenever new opportunities emerge from emerging trends, their instant gut reaction is, "It's a scam, it's just designed to fleece regular folks. It can never last long." They hide their own lack of knowledge behind cheap dismissals. By shutting their eyes and ears to change, they miss wave after wave of market windfalls. Let's go over 2 classic real-world examples of this costly close-mindedness. Case 1, old-school brick-and-mortar business owners writing off e-commerce and live-stream sales. Back when online shopping boomed around 2010 and live-stream commerce blew up in 2018. Countless physical store and factory owners scoffed aloud. Who buys clothes without trying them on? How can anyone sell goods watching silly live-stream acts? It's all fake order scams. Brick-and-mortar retail is the only real business. Refusing to learn new sales channels and closing themselves off to new info, most got wiped out by market shifts within just a few short years. Case 2, traditional creators and office workers instinctively shunning AI starting in 2023. After ChatGPT and Midjourney went mainstream, hordes of coders, designers and copywriters put up defensive walls. AI writing is garbage, AI artwork lacks genuine creativity, it could never replace human workers. They refused to integrate AI into daily workflows and banded together online to bash AI tools. Fast forward to 2026, competitors who mastered AI to cut costs and boost output have squeezed them nearly out of the marketplace entirely. The second flaw crushes countless hardworking people instantly. Some of you may argue, I'm not lazy at all. I work overtime deep into the night and spend ages studying investing every single day. Folks, this is nothing but physical diligence paired with crippling mental laziness. Most people's so-called hard work is just endless repetitive labor and mindless time wasting, a convenient escape from the grueling work of deep critical thinking. They refuse to dig into core business fundamentals or parse financial statements. All they want is a stock ticker handed to them by online influencers, random insider tips from dinner chats, or a ready-made playbook to copy blindly. Tactical business like this is the hallmark of an intellectually immature mindset. Two real-life examples lay this bare. Case 1, the endless grind loop of food delivery riders and ride-hailing drivers. Plenty of middle-aged workers stuck in career burnout drive for ride-hailing apps or deliver takeout after their regular jobs, slogging away till 2 a.m. and patting themselves on the back for their hustle. This line of work demands zero intellectual effort, only raw physical stamina. They'd rather drain 16 hours wearing out their bodies than spare 1 hour reviewing their core strengths or picking up new skills for an asymmetric career shift. Once their physical stamina fades with age, poverty becomes inevitable. Case 2, handout-seeking retail investors haunting finance forums for hot stock picks. Another group of retail investors hangs around investment communities non-stop, scrolling through hundreds of analysis articles and liking every creator's post. But ask them to go through a public company's earnings report or calculate asset allocation percentages, and they get annoyed right away. Their go-to question is always, just tell me which stock will rise tomorrow. They hide their refusal to think independently behind the fake diligence of endless phone scrolling. The third flaw is the most gut-wrenching and fatal mental cancer of all, the inability to let go and move on. In economics, this goes by a well-known term, the sunk cost fallacy. Most people stay poor their entire lives not because they never made good choices, but because they cling stubbornly to decaying, worthless past investments and paths long past their expiration date. They cannot let go of vanity and pride, nor reconcile lost capital and years spent chasing lost causes. Fooling themselves with hold on a little longer, it might bounce back. They stay aboard a sinking vessel and watch their remaining money and time get devoured by the market. Two heartbreaking examples illustrate this refusal to release sunk costs. Case 1, trapped investors holding losing stocks all the way to total loss. Many retail traders refuse to cut losses after a 20% drop, fixated on the money already gone. Once losses swell to 50%, selling feels impossible. If I sell now, the loss becomes permanent. Even as business fundamentals collapse and delisting looms, they develop irrational attachment, vowing I'll pass these shares down to my kids. Locked into a rotten stock for years, they miss every bull run in promising alternative assets. Case 2, boiled frog workers stuck in declining dying industries. Countless staff in legacy print media, outdated tutoring services and fadding manufacturing see their sectors shrink annually amid rolling layoffs. Yet after 5 or 10 years on the job, they refuse to abandon seniority and their familiar comfort zone, terrified of the uncertainty and growing pains of switching careers. They linger passively until their company collapses in their 40s, leaving them without marketable job skills to survive. Once you bravely face up to and cut out your 3 mental cancers, close-mindedness, mental laziness, and obsessive sunk cost fixation, congratulations, you've already outmatched 90% of all market participants and earned your spot at the starting line for genuine wealth building. Now for regular folks with no family connections or startup wealth, how do you build lasting prosperity using these proven, fully accessible rules? At the top tier of wealth building, riches never come down to luck or picking a skyrocketing speculative stock. It follows a complete closed-loop system. Expand your mindset intelligently, deploy productive leverage, and iterate quickly. Master these three core roots, and growing wealth is only a matter of time. Let's look at three iconic figures who rewrote their destinies following this open blueprint. Path 1. Keep expanding your knowledge base, beat close-mindedness, build a thoughtful information filter. Most average people build defensive mental firewalls against unfamiliar ideas, while wealthy people build refined screening filters instead. When facing novel industries, platforms and tools outside their existing knowledge, sharp investors never rush to mock them. Instead, they stay open-minded, observe, study, and dissect new things with a blank slate mindset. Take Ray Dalio, founder of Bridgewater Associates. His core tenets of radical truth and radical transparency helped his fund weather multiple global financial crises. He mandates himself and his team stay receptive to all anomalous market signals, admit what they don't know, and soak up fresh data like a sponge. Staying intellectually open means downloading and testing new tools like AI firsthand, even if you can't grasp them at first. Every time you stretch the limits of your understanding, your capacity to accumulate wealth doubles. Path 2. Master leverage, the core accelerator in the wealth formula. You can never grow truly wealthy solely by trading your physical labor or limited hourly time. Everyone only gets 24 hours a single day. Affluent people spend their lives hunting and building four categories of leverage: capital leverage, labor leverage, code leverage, and media/online leverage. Take Bill Gates as an example. By creating the Windows operating system, code leverage, he could duplicate and distribute the software to hundreds of millions globally via disks and the internet with nearly zero extra raw material cost, fueling an exponential, nonlinear surge in his net worth overnight. When everyday people build social media channels, publish ebooks, or develop standalone online tools, they're essentially tapping into two ultimate modern levers: media and code. These cost almost no upfront capital, yet let you replicate your work infinitely beyond your limited time. Without leverage, you build wealth by slow addition over a lifetime. Once you master leverage, your wealth compounds multiplicatively. Path 3. Beat theoretical thinking with MVP trial and error. The third path crushes armchair planners entirely. Validate ideas with minimum viable product, or MVP for short. After locking onto a potential opportunity, most retail investors and office workers get trapped in perfectionism, stuck thinking, "I'm not ready yet." Some waste an entire year drafting polished business plans. Others dump all their savings into a startup in one go and end up losing everything. Top-tier founders like Airbnb's co-founders did the exact opposite. To test their idea of letting travelers rent air mattresses in locals' homes, they skipped pricey office leases and complex coding work. They snapped 3 photos of air mattresses in their own living room, posted them on a bare-bones makeshift website, and landed 3 paying guests the very same day. That's how MVP works. Build a stripped-down prototype at minimal cost of just a few $100 and launch it to market fast. Scale up investment immediately if market response proves strong, pivot quickly if results fall flat. When each trial costs little and moves fast, you get endless shots to experiment. This is not reckless gambling, it's high-frequency, low-cost testing that tilts the odds of striking a lucrative breakthrough in your favor. Well done sticking with me this far. If you've followed along all the way, you've already outpaced 95% of casual viewers who bounce away after 30-second clips. This 1 hour of focused learning has delivered a fundamental wealth mindset overhaul from the inside out. Over this full 1-hour structured session, we've fully broken down and rebuilt the roadmap for everyday people chasing genuine wealth and personal freedom. In Chapter 1, we unpacked the frenzy of buying on market hype, the overconfidence of bargain hunting, and mindlessly following trending fads while abandoning independent reasoning. We learned blind, misplaced conviction only leaves you footing the bill for big capital's profits. In Chapter 2, we flipped your definition of loss, and grasped why it pays to take early investing setbacks. You forge a rock-solid long-term investing and asset allocation framework through early losses, then feed steady fresh capital into this system via asymmetric bets built around mastering your core career and testing diverse side ventures. In Chapter 3, we laid out the open blueprint to building wealth. We redefined true wealth. It's not flashy material possessions, but full ownership of your own time. We cut out 3 crippling mental flaws: close-mindedness, mental laziness, and sunk cost obsession, and uncovered 3 actionable paths: expanding your intellectual horizons, harnessing leverage, and rapid trial and error with MVP prototypes. Investing in yourself is the only guaranteed profitable investment in existence. This hour won't make you rich overnight, yet it can spare you years of costly financial missteps over the next 5 or 10 years. Wealth never materializes out of thin air. It is simply the tangible payoff of your accumulated knowledge. If this in-depth session has torn down your old limiting mindsets, complete these 2 simple tasks. It supports our team's months of content development and marks your first step from learning to real action. White heavy check mark Step 1. Like, subscribe, and hit the notification bell. Tap subscribe so you never miss our weekly breakdown of foundational wealth-building principles. Share this video with friends stuck stressing over stock trading or lost in their careers. You might alter their entire financial trajectory. White heavy check mark Step 2. Drop your personal commitment down in the comments to boost algorithm reach. Leave a comment answering which of the 3 mental flaws hit closest to home and cost you the most money. What's your very first planned change moving forward? I'll handpick thoughtful, reflective comments to pin and reply to in depth. Writing your goals down is where real transformation begins. Thank you for sticking through this full hour of mindset evolution. Break free from your mental shackles and reclaim full control of your time. I'm your wealth coach, and I'll see you inside our exclusive member community for our next session.